Welcome to day 8. This is all about debriefing and then continual improvement based on those debriefs. This is the element of your day that actually sets you apart. It's not about your individual trades, about how you actually did on one day to another. It's about what you learned from it, but also what you've taken from that learning, how you're going to use that to make yourself better in the future. It's all right saying, oh, well, I learned this, that was an interesting point, and then not learning from it. It's this structured learning, this creation of a deliberate practice, the creation of monitoring that is very, very important going forward. So how are we going to go about this? First up, we're going to have a look at trading. I'll explain the process of the debrief in the next slide, but we'll have a look at trading, have a look at metrics that have changed throughout the days. This will allow you to identify where you should be looking at trading in the coming days, and also information to carry forward. What's changed today? Are there any patterns that you're seeing, things that you can start taking advantage of in the coming days? And then again, it's going to tell you when certain things are stopping to work, or certain pieces of price action, chart patterns are no longer there. So that's the first element of your debrief, taking those bits away. Next up is assessing your performance. Very important, of course, assessing your strategies. I know we spoke about strategies before, but going through each of your strategies, looking at where you are implementing them on the day, going over your charts, actually noting all of these strategies down on charts, as well as journaling. This is where you step away from the charts, away from what's actually gone on throughout the day, and actually how you've reacted. What has affected the way you've traded? Is it something external? Is it something to do with your attitude to being up or down on the day? All of those elements that play in your mind as well. Trading is more a mind game, in my opinion, than being able to read a chart. And also monitoring. Of course, you do need to be monitoring where you're going right, where you're going wrong, where you're making money, where you're not. And finally, both of those areas of debriefing will lead on to improvement. The improvement side of it is where you identify what you're doing well as what you're not doing so well. There's no point in just focusing on what you're not doing well. If you're doing something well, this is a fantastic opportunity to build your size, to increase your confidence, to really push what you're doing well. Because if you can identify those areas, you can just completely step away from things that you're not doing so well at with confidence that you've got what you're doing well. It allows you to set goals going forward, and also we have an element of how you track those goals, because that's very important. That again is all about maintaining your confidence, and also it gives yourself a chance to reward yourself. If you're achieving those goals that you're setting yourself day by day, those small things just to add to your trading, then you do get a great sense of achievement, and you should be rewarding yourself. That's what's going to drive you to continue doing that improvement. How do you go about your debrief then? This is how I like to do it. The reason, and I'll explain the reasoning, is that what it allows you to do is reset away from focusing on your P&L, focusing on how you did on trade, so that when you do come to look at those areas, you do it a lot more objectively. You actually look at what happened, what changed, whether you did make money or not, rather than focusing on a trade that perhaps you didn't do so well on, and all of your debriefing of that trade is, well, I should have done this, I should have done that, that was a bad entry, that was a bad exit, etc., etc. So step away from it and first address the actual metrics. What's actually happened throughout the day? What markets have moved by how much? And then move on to the fundamental drivers as well. What new news have you gained throughout the day? What's changed? And then move on to looking at your technicals. That's where you can actually assess really objectively what has actually gone on throughout the day, rather than the other way around. So go through your metrics first, then go on to your fundamentals, and then with a fresh mind, once you've moved all of those little bits out of the way, you can then come on to assessing what you've actually done throughout the day. Now, when I spoke about market metrics, what I like to do is actually keep a note of where all of the markets that you're trading, or relative markets that you're trading, have actually got to throughout the month. Now, the example here I've got is of equity markets, and this just gives you a snapshot of the beginning of January. Now, the reason I have it in a table form rather than just looking at charts, and it does seem a little bit more clunky in table form, but I do have some reasoning for this. Looking at charts is very easy to just look for a chart and go, oh yeah, that market's gone up, that market went up and broke yesterday's high, that market didn't, for example, so therefore X market, and say the Nasdaq must be stronger. The difficulty is with that is you can lose perspective of what's actually been going on throughout the month. So by having it in a table form, you can very quickly see what markets are performing well, what are not so well. Very clearly from this table, we've got the DAX, FTSE, Euro Stoxx, S&P and Nasdaq. You can see that the two best performing markets are very clearly the Nasdaq and the FTSE. So throughout January, if you're looking for upside plays, they're going to be the areas to be looking for. The weaker markets very clearly are in Europe, namely the DAX and the Euro Stoxx. So by filling it out by hand as well, this also really imprints it in your head, and that's really important too. If you've not got things really driven into your head, and this is for me personally as to how I put things into my mind by writing them down, I think is much more important than just trying to remember something. It's a very good memory technique. If you tell yourself a story including the things that you're trying to remember, then you remember them a lot better. So it's a similar idea to that. If you actually note them down at the end of each day, and again this is to step away from what's actually been going on, you realize that certain markets are outperforming others. So by doing this, and you can do this across whatever markets you trade, be that bonds, be that say the euro against various different currencies. Again, that shows you how the euro is likely to perform over certain events, what currency pair you want to trade the euro against. Example, using a yen rebasing chart. Now, if you have an access to a Reuters terminal, what you can do is you can pick a time period or a time in the past to begin your rebasing. This will set the yen against various different currencies or whatever you choose, and then show you what it's done percentage wise up until a certain point. So this could be from say meeting to meeting, Bank of Japan policy meeting, or just up to now if you're looking to trade the yen on a number, for example. So what this chart shows you, because the way the yen's quoted, yen strength is actually a move down, yen weakness is a move up. So you can see very clearly that yen is generally weak at the moment, or in this chart, against the pound sterling and against the Canadian dollar. It is showing a little bit more strength against the US, the euro, and also very noticeably you see that recent strength in the yen against the Aussie dollar. So that's giving you a very clear clue as to what you would be looking to trade. If say for example the Bank of Japan eased monetary policy, then you'd be looking to trade the yen against the pound, because the pound's already showing strength against the yen, is likely to continue that strength. Whereas if you see tightening, then you're looking to trade probably the Aussie against the yen, because that's where the yen is already picking up strength, and it was also recent strength as well. So what that's telling you is recently the yen has become that little bit stronger, is likely to continue. The trend is starting to turn there, whereas the dollar and the euro remain reasonably flat, despite the fact that they are marginally stronger on the month. The recent trend in the Aussie, that's where you'd be looking for if you're looking for a bit of strength in the yen. So that's how I'd use a rebasing chart. Gives you a very good idea of what's changed and a little bit more visual. However, maintaining the spreadsheet does stick it in your mind a little bit better, in my opinion. Once you're through your market metrics and what's actually changed percentage wise or continuing to change throughout the month, you're then looking at fundamental news and information to carry forward. You don't need to remember every little bit of news that's happened throughout the day. However, there's going to be key things throughout the day that you really need to be picking up on and just carrying this forward. This phrase that I like to use, I use it for levels, I use it for information. So things to carry forward. First up, you want to be considering any comments that have come out throughout the day. These can be comments that have been scheduled. I think a surprise comment in particular is often a little bit more important. But what you need to assess with these, and this is where it becomes key in carrying the info forward, is has it actually changed from the norm? Is someone just repeating something that they've been talking about very frequently recently and they've just had another chance to reiterate the point? Or is it actually a break? Is there new information in that? That's the key element. That's where it's really important, the new information. And again, you then need to assess how important that is. Who said it? If, say, for example, it's a central bank comment or a speaker from a central bank, if they're a hawk and they've said something hawkish, again, not quite as important. But if they change the trend and say something dovish, this is very, very, very important. So all about who, how important that person is, how important the information is, and also what would be the implication of it. Start thinking very quickly about what the trade would be, what you would do if they continued along this path, what you'd expect the markets to do in that vein. So that's the first thing, any kind of comments. Next up, economic data. Similar idea, but what you're looking at there is, has a trend changed, or is there a key point that markets are looking for? So for example, with inflation data, a further increase beyond a recent high in inflation, or an increase beyond a targeted rate that a central bank may be looking at, or anything beyond the norm that we've seen over the past few years. So if your average, say, increase in non-farm payrolls, anything out of the norm, carry that forward. You're then looking to see a trend develop, or that to be an anomaly in the next month. What this does is it focuses on similar events coming up. So say it's an inflation number, inflation will then be very well watched at the next economic piece of data that has an inflation element to it. So that's where the information is very important to carry forward. Note it down, put it in a diary somewhere, keep these things written down so that you've got them all banked. And it just gives you new areas to focus on, new things to be thinking forward on. Any rumours as well. These are always very, very useful things to pick up and carry forward. Any rumour, generally the better trade is if it's denied. If you have a rumour, the market starts to price in the possibility of this rumour actually being true. Once you have the denial, you then see the unwind of that. If the rumour is confirmed, you've then got to judge really how much more has the market got. Often what the trade will be on a confirmed rumour is the little flurry where the last few people hear the confirmation, or that's the first time they hear it. You then know that there's people already positioned for that. As soon as that last flurry of movement comes in, then you see the reverse move as the people already in get out into that last flurry of movement. So again, it's all about building scenarios, building in what would happen if these certain things did come to fruition that has been mentioned. And of course, any upcoming events, if people mention that there's going to be a very important meeting, if they talk about a certain date in the future that something is likely to happen or a target needs to be met by, have those things written down, know exactly when that's going to happen, because a lot of the time the market won't have remembered that, and you being on the ball, when you see something on that certain day, you're going to be that little bit of a step ahead whilst everyone else thinks about it and thinks, oh yeah, I remember now, or it comes as a bit of a surprise to them, despite the fact that you were semi-expecting at least something or some kind of news on that update. Great example of this, the ECB a couple of years ago said in a comment or a source a few weeks before the meeting that they would reassess their monetary policy at the meeting. So this, again, you knew that meeting all of a sudden was live. Something big was coming out of that, and that was all through just carrying forward that information. So make sure you really do note those things down. Put them in the diary, particularly anything that has got a very clear date on it, and also check that diary to make sure that on certain days you're ready for whatever that bit of information was. Now, with the technical information to carry forward, we always come back to that good old question that I've spoken about during the technical day. What's the market trying to do? and how good a job is it doing of it. Now, in assessing this, you need to be thinking about what levels have been broken. Are the levels that the market has moved through very significant? And does that imply that moves could be continuing? You want to be looking at volume changes as well. If you're starting to see a pickup in volume in certain markets, then this is giving you a clue that chances are that's a market that you want to be considering trading at the moment. I watch very closely at volume in certain markets, that if it starts dipping off below a certain amount, and again, if the ranges start contracting below a certain amount as well, I will step away from that market. It generally implies that my edge is moving away. What it does is it can very early give you that indication that you want to be just stepping back for a little bit and focusing in other areas. Also, do consider any references that have been left behind. So if a market is shifting higher and constantly not testing back to previous closes, not testing back to previous VPOCs, what it's showing is the market is actually quite weak, because these areas are not being tested to see any new buyers if they're there. So you're just seeing this push up in the market without any real sort of strength behind it. And often, by noting that down, you know that if the market does start to turn over, you could have quite a big flush, and you've got some very clear targets to the downside for you. So do keep an eye on those kind of things. Again, I've not actually put this on the slide, but a similar thing with that is if you're seeing the moves always in the overnight session, what is then happening? Is that move held on to? So if, say, you see a continuation move in the overnight, are those moves continually held on to, or are they starting to reverse? The first time you see the opposite in the overnight session, then that's giving you a clue that something's changed, and you then want to be thinking about your trade in the following day accordingly. So what this does really, and the aim of noting down info to carry forward from the technical side, is it just steps you away from focusing on smaller levels from the intraday time period, and actually, you know, brings you back to taking that bird's eye view of the market, really assessing what is actually going on in the bigger picture. And this maintains a little bit more perspective, and also can maintain a bias, and I'll give you a good example of that in the next couple of slides. Got here a good example of that, stepping back from the market and actually thinking about what the implication of a bigger picture move is actually going to have. So what we've got here is the Bund market, and this was the uptrend from the beginning of 2014. Now, it would be very easy to see a little bit of a volatile day and then think, right, we're probably going to be looking for a bit of consolidation the following day. However, in this example, what you can see is that massive uptrend is broken. And what that tells you, if you're noting that down, if you're making sure that you're aware of that and you carry that information forward, you know that over the next few days, there's going to be a lot of people that have been able to hold a position for the best part of a year with very little pressure on them. They're all going to start coming under pressure. And this is going to cause more than just a small down move or a slightly larger than normal day. The move is likely to be sustained, and that's exactly what we saw. It took the Bund 5 days on the break of this trend line to move down 500 ticks. So that's a pretty decent sized move. We then saw a slower bounce, but again, as soon as we traded that Bollinger Band, the steep Bollinger Band that you can see coming down, it's a trade that I do like a lot, particularly on the dailies if you move up there quite quickly. As soon as we got back up there, we then saw the flush again, and it was another 600 ticks that the Bund moved down. So you saw over a period of a month, a huge amount of that move taken away. We actually dropped all the way back to the 38% retracement. So nearly 40% of that move was taken off. And just by remembering or noting down, carrying forward the break of that big trend line, you know that over the next period of time, you're likely to see bigger and bigger moves coming in the Bund as people are put under pressure. You see volume increasing at the bottom. You see the ATR, the histogram above the volume, showing you that these things are increasing, and it gives you a very good idea of what's going on. We again see on that break, that 200 period moving average has not been traded for a long time. That's going to be a target on that breakdown, and that's where that first 500 ticks takes you down to before the bounce. So keep those things in mind. like I say, that pulls you back and gives you perspective from a bigger picture, and that's really important. That will just keep in your mind that, you know, at the moment the market is doing a good job of moving down. It's broken that big trend line, and so you need to continue looking for downside pressure in the bunds once you've seen that break, at least down to that 200 period moving average. So you've got 500 ticks that you will be looking for short, so you are very likely to take a great deal of the advantage on those type of trades. So that's the key importance to carrying info forward from the bigger picture. Next up on that technical info to carry forward is the actual specifics from the days. This is where you can start moving towards the trades that you've actually done throughout the day and start really assessing what has been going on in the market. So any specifics, any very specific trade ideas or things that you're starting to see, get these down on your prep sheet for the next day. Write them down the night before so that they're there, so you don't have to try and remember them the next morning. So you're straight away looking out for certain things. Note down any trades that are working particularly well. Often when you see a trade working quite well, this will repeat for a few days. So things like VWAPs, reversals in the morning, anything like that, they're likely to repeat. And a trade that is going to repeat, usually the second day that you see something, if it does repeat, the second time you see it is usually the best. Come the third, more and more people are starting to notice it and it becomes a little bit of a weaker trade. Come the fourth day, this is when the trade often starts to change. And again, note that down. Note that that trade is no longer there, because that's going to immediately stop you looking at it and going, oh, 5 days in a row, we've got an opportunity again. Of course, it does happen and you do see a continuation for a longer period of time. But the quicker you notice it and take advantage early, then the easier it is to step away when you start seeing that stop working, because you don't feel that you're owed anything because you've missed day 1 and 2 that were the bigger moves. So again, noting down those specifics, that's where you get really paid for doing that. And also things that can't be seen on a chart. The next day you'll look back at your charts and you'll be able to see that it traded down to certain levels, and this is where charts are very useful in reminding you of what's happened. What they don't tell you is specifics that you've seen on the ladder. So is someone continually reloading a certain level? You know, every time we come down to a certain area, does it get reloaded? Are you seeing people buying and a bounce off a certain area consistently? If that goes away, then the market should move quite aggressively through that area. So all of those little things, keep noting them down. Note them down each day that it continues as well. Something else that you often see occur is a chasing pattern, whereby someone will have a large order and they will chase the market to get that order done. This again can occur over a couple of days. So you see it once, the next day you know that it's likely to work. If you start seeing those orders come in, gives you an opportunity to get on it. Again, over time people will see those orders and then hit them straight away, so you won't get that chasing at all. So that again, carry that info forward and note it all down. Something that I do every time there's a data release, any kind of data release, note down what happened. Quite a lot of detail as well. What the market did on the very first move. Did it pull back? How did it react when it pulled back? Get those things down. Record them if you can as well, because then you can re-watch them. The more you re-watch them, you practice in your mind that recognition of the price action, and that will allow you to create a trade or not around that, or tell you when to step away. Ultimately, always what you're trying to do is look for potential new trades. That's the greatest thing that you're trying to achieve with this. Any new trades is a new opportunity. You're just adding the string to your bow. You're giving yourself more areas that you can make money in, and that is the point of carrying this info forward and of any of your debriefs. Here we've got an example of carrying forward specifics from the previous days. This is in the DAX. Now what I've got there is each of those horizontal lines is where the reversal begins to happen, or where you get the clue on the reversal. Now the graph at the bottom shows delta. What that is the number of orders that are buying at market versus number of orders that are selling at market. What we got was a delta divergence, whereby as the market made a new low, the delta did not go lower with it. So people were not chasing the market and aggressively selling. So you weren't seeing new selling coming into the market as we made new lows. This immediately should be triggering something in your mind saying, this market isn't really got the energy to continue this move. And these are the times where you do get that fast reversal, you get a very aggressive move higher. And we saw this for a few days in the DAX, whereby you would see this drop, a bit of a grind down, and then as soon as you saw that divergence between a move lower in price but no new low in delta on all of those horizontal lines higher, I've just used them to mark, they're not actually time based or anything, they are to mark on those areas. As soon as you saw that pattern change, you knew after the first day that that rip higher was likely to be very aggressive, very fast. So you're thinking, right, how am I going to make a trade out of this? The way I do it with a 1 minute chart. I have a downtrend on that grind phase, and as soon as you start seeing it turn over, as soon as you start seeing the low without the delta confirmation, any break of that shallow downtrend, I'm looking to get on for the aggressive move up. As soon as you note this down, you've spotted it, you're looking for it for the next few days. Even if it doesn't necessarily give you a trade, even if you haven't created a trade idea and a specific trade out of it, what it does is it will prevent you getting caught short. As the market moves higher, it will prevent you getting caught short trying to sell areas thinking that this is a pullback, and you'll know that it's likely to push straight through those areas. And that's where you could, even if you've not looked into a trade specifically to catch the move towards the lows, it is likely to flag, it is likely to show a bit of price action that will allow you to get long and at least take advantage of some of the moves. So there you go, perfect example of carrying forward specifics from the previous days. Now you've actually gone through your metrics and actually carried the information forward that you've deemed to be relevant. Now is your chance to actually go over your trades, go through what has actually happened and see where you've been doing the right thing, doing the wrong thing. Now, something that is very, very important to remember. If your trade is a losing trade and you lost money on it, doesn't necessarily make it a wrong trade. That's something really key to remember. It's very easy to kick yourself and start dismissing trades just because you've had a couple of losers. No trade's going to be perfect. No strategy will win every time. So just remember that. Did you do the right thing though? And that's where a trade can be a good trade, even if you lose money. If you got out at the right time, if you got out where your strategy told you to, you didn't sort of think, no, but this time might be different, or become hopeful, then you've still done the right trade. Just because you haven't made any money shouldn't stop you at least taking some feeling of success away from that. This is the point to start journaling things as well. So go through your trades, annotate your charts, write as much information on your charts as you can. This confirms what's developed throughout the day. It also allows you to go back and look at what your plan was at the beginning of the day and really assess how well you're planning for the days. Is that an area that you need to start improving? Are you misjudging what's exactly going on? In this chart example I've got here, feel free to come back and read over what I've actually written down on it. This is something that I wrote down myself in my own debrief on the DAX. And it sets into my plan, the fact that I did expect to move back to that VPOC that you can see, and we got that after the ZEW number. This again goes back to that previous slide that I was saying about that reversal trade, and you can see that downtrend is where I was looking for that reversal trade. The delta didn't go lower, so after the ZEW number it gave you that chance to buy. So what it does is it confirms that my plan at the beginning of the day was right. What I did badly was not maintain that plan when the opportunity came, because we'd moved a long way from what I thought was going to happen. Doesn't necessarily stop a trade still being there, even if we do come back to it. So that's something that I took away from this that I needed to remember. What you can also do, I do this with certain things, so I feel that I'm changing the way I'm doing things, is add your fills in as well. Put in exactly where you bought it and where you scaled out of the trade, where you got out and why. What this will allow you to do is, it can improve your strategy for one, of course it can. It can point out if you're getting spooked out by a certain candlestick formation or price action. But what it also allows you to do is relive the trade. If you're reliving the trade in your mind, what this does is it brings back some of those emotions, and this again is a chance to relive some of those emotions and realize what it is that sort of gets you psychologically to exit a trade or to become hopeful. And if you notice those emotions coming through in the future, that's where you can start trying to not suppress the emotion. You can't just suppress an emotion, but what you can do is you can realize it's coming and then think to yourself, right, I need to really stick to my stops, stick to what the strategy says when this happens, to stop those emotions overtaking the trade that you're doing. And of course, the main reason for annotating your charts and putting your fills in is to assess whether it matched up with your strategy. Are you doing the right things? Was your strategy right? Does your strategy need improvement? Are you seeing something in the charts and something in the way that you've traded that can actually make your strategy even better? It's not all about the losing trades. If your trades worked well, are you actually needing to actually give it a little bit more? Is there a possibility that you can start looking into holding the trade for a little bit longer, or looking for continuation in the trade rather than just getting out and taking your profit? So it is always going to come back to how can you improve your trades, improve your strategy. But journal these things, write them down, write how you felt as well on your charts, because that really does inform how you react at certain points based on how you felt. Now, when I mentioned keeping a journal, I didn't mean to just keep a diary and talk about what's happened throughout the day. I like to do this in a bit more of a structured way. The main reason for having a journal as well is it takes your focus off the P&L. It brings you back to your process and gives you a chance to assess how well you're doing at actually continuing your process, doing the right things according to your process throughout the day. It also allows you to view your day as a success as well. If you've managed to learn something from what's gone on, take something away from it, then your day can still be a success, irrelevant of what your P&L is. And what it also does is it identifies your common difficulties. If you're often seeing the same kind of thing, whether that's mental, whether that's certain types of trades that aren't working, or certain things that you just don't see how you can get involved in those markets or that type of pattern, then it allows you to change that or to erase that difficulty. Remember, anything that isn't repaired is repeated, and you don't want to be making the same mistakes over and over and over again. So the way I go about it is I do have a table. I assess my energy on the mornings and the afternoons. I do find that if I come in particularly tired, I'm not going to perform very well in the morning. I'm actually better to not come in for that part of the day. I'm not always advising that you shouldn't come in. Some days, if you're very tired, but there is something going on that you are very aware of that is very important, you've got to overcome that tiredness and come in for it. But generally, if I'm lacking energy, then that's telling me I need to do something about that. Do I need to get better sleep? Do I need to eat better for a little bit? It's not all about the trading. Again, it gives you a chance to look at your plan, your conviction. I always assess my conviction, because if you've got a lot of conviction and you're not necessarily seeing your size increasing on those trades or your P&L improving, you've got to question what you're doing with that conviction. Are you just very convinced that something's going to happen and not acting on it? Or are you becoming overly convinced and overly sure of something with no real reason behind it? Again, confidence as well. If you can see a progression in your confidence, this is going to make you feel good. It's going to help you trade a lot more freely if your confidence is building up. And again, assess your execution. That is one of the very key elements of trading. If you get your execution right, you're not giving away little bits on getting in and out. You know, think of it like that, that every time you get your execution wrong, you're giving up a couple of ticks. And throughout the year, think of the number of trades you do. If you do 50 trades a day and you're giving away 2 ticks on every trade, that's 100 ticks every day that you're giving away just through poor execution. You could be right, you could be getting trades, you know, going very well. But if you're losing 100 ticks every day on execution, that's going to really add up throughout the year. So try and erase those kind of things. Execution is so key, so I do assess that every day. In the notes, be honest with yourself as well. Don't just talk about what happened in the market generically. Talk about what you did. Address it to, I did this, I took this trade. Because if you make it more personal, you feel more accountable to it, and it also really instills what's actually been going on, rather than saying you should be in here, you should be looking at this flag, this trend line. That makes it impersonal, and it makes it very easy for you to just walk away and say, well, it didn't really affect me. If you say you know, address it to yourself, be honest, make notes that are constructive as well. You know, point out where certain elements did work. You know, was your plan right? If it was, make sure you do note that down, because again, this is all about building confidence over time. That's where the journaling is so important. Now, when I monitor my trading, I don't just look at the ticks that you make and your P&L. I like to look at the number of ticks that I'm taking per clip. What this tells you is how well you're actually doing if you start to increase your size. If you are averaging a certain number of ticks per clip, in this example 1.85, and you then increase your size but see that start dropping, what it's telling you is you're trading in a slightly different way. You're starting to deviate from your strategy and your plan because your size has changed. So that's the first reason that I start to look at ticks per clip. What this also does as well is it gives you a bigger picture of what you're actually doing, and maintains your sort of ability over time. It shows you what you're doing over a period of time. So when you look at the number of ticks taken, the average on this month, these are genuine figures of mine from trading the DAX. The average that I'm taking is nearly 30 ticks a day. What this can tell you is that you can consistently make that many ticks on any day. So all you need to do then is, if you want to make an X amount in a month, you need to be able to learn how to scale the size that you're trading. You're still only really looking for those 30 ticks a day, but it allows you to change the size, knowing that you're being consistent in what you're making ticks wise per day, rather than just an average P&L, which could be skewed by perhaps one event or something like that. Now, what you also want to be looking at is how well you're actually running your profits and your losses. So on the days that you're losing, are you doing something different in terms of your losing more ticks per clip? Now, there's a couple of days that you can see. The days when I lost 9.5 ticks per clip, and also one where I lost just over 6. I clearly let my strategy get a little bit away from me there, and I was allowing losses to run a little bit, and you can see that I also ended up losing 70 ticks on that day, in terms of number of ticks taken per clip, rather than just traded or just taken for the day. So what that saying to me is, on a couple of days I am not really sticking to my strategy, and they're the days that I will go back and actually really think about and go through what I did or what made me stay in a trade. You know, if it was bad luck, then you can perhaps, you know, put that to a side a little bit. But if you are consistently noticing that when you have a down day, you're losing a lot more ticks for every clip that you trade, then you need to address that. You're clearly letting your losses run a lot further than you're letting your winners. Conversely, you can start to see the days that you've done quite well, that you are allowing winning trades to run. You know, there's days where I got up above 6 ticks per clip. That's something that I do start to look for. So that again allows you to benchmark yourself. That's your other way of increasing your earning capacity. Can you take out more ticks for every clip that you're trading? Can your strategies be adapted to actually start boosting the number of ticks that you take out of the market? So I clearly have done well on a couple of days where I got up to 11, as well as another 9. So what I'm seeing there is they're the days to go back and look for improvements and how I can actually make myself better on those days. It's not all about just picking out where you've not done so well. So that's why I monitor it, not just based entirely on my P&L.